Okay, welcome to ABK Cashflow. This is video one. Basically, my plan is I've learned to basically to make cash from the markets, and I know many people will be interested. And so what I'll do here is cover basic after basic after basic. So this will be episode one. I'll kind of do a Joe Rogan style, it'll be one, two, three, four, five. Um, I hope I get as big as Joe Rogan. he's 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 big as. But let's start um, from the basics. Now, my channel, ABK Cashflow. Now, ABK. Now, my name is Blade K Ace, and in the old days, I don't know if they still do it, but they used to write their last name's initial first, so it'd be like A, and then I think they do like a comma, and they put the first initial and any other initials they have, right? So that's how ABK came about. And my name has kind of come to represent me, Blade, like don't try to cut the crap out of life, like try not to get caught up in the bullshit, just get to the point, you know what I mean, and ace it. So it's come to me, the ABK has come to mean uh, A to B, you know. And when I catch myself not going A to B and wasting time, drives me nuts. You know what's worst is you think you're doing it A to B, and then later you realise, shit, that was the wrong way around. That's the worst. But then next part is to the point. Now, if you notice, the K has like a arrow and then a line. So it's like to the line being the arrow being to and then point. So I've made a little something out of my name and initials that comes to, I think, represent what I aim for. So that's what we're going to aim for. Now, I'm going to swipe forward or back. Which one is it? One of these. Okay, forward. Okay. So now I had a question um, from Miguel. Miguel asked me, how can you get out of the rat race uh, on the stock market when you'd need like, wouldn't you need like half a million? Sorry, yeah, half a million, like $500,000 to, because the average earnings are like on money at 10 or 20%, right? So to get 50 grand to live on, wouldn't you need like $500,000 to be able to get out of the rat race? Well, Miguel, I'm going to try and answer your question. So I'm going to start now. I just happened to have this presentation here because I was going to use this presentation to try and get some more capital. Because people ask me, okay, well, I can give you my money and you're going to get me 10% on it, but well, you need to tell me something about what you're doing and how you're doing it. So this is kind of what I would show someone, which I haven't done yet, but I'll come around to it if they were one. If I was trying to entice them to get more capital, because of course, more capital, more I can generate. But you don't need necessarily $500,000 to exit the rat race, and I'll just explain how. So you've got assets like your phone, your Oh, I should time this, shouldn't I? So that's not too long. Try and keep it short and sweet. Here are some assets. You got iPhone, house, car. All right. And for your asset, you give money to insurance company. This man here is Mr. Insurance, right? And you give him the insurance money. Oops, wrong way, this way. So, in case there's like a windstorm comes and hits your house, and then your house is rubbish, right? Now, if that happens, the insurance man will give you money so you can get a new house. You see? And then now, so that's where I come in. And that's where you would come in as an investor in the market. You're like the insurance man. You're not buying the stock, so you're not buying the house or selling the house. Another way to get money from the markets is not buy the stock, but be the insurer. Okay, so this insurance man here, the amount of money he can make depends on the pool of money he has. Okay, the bigger the pool of money, the more he can insure. The smaller the pool of money he has, of course, the less he can back up. Okay. So the bigger the pool of money, the more he can insure. He can back up this car, he can back up this phone, he can back up this house, you see. So the bigger the pool of money also, if you notice on the previous video, the arrow is going this way. He can insure this because he can give that money to insure that. And on the next slide, you've got the arrow going the other way, which means this guy wants to insure his house, this guy wants to insure his phone. They give money to the insurance guy, and he can only collect as much as his pool will allow him to back it up. You see, so the bigger the pool, the more he can collect. Right. So now let's go into stocks. Just keep that in mind, insurance. Now stocks is like, let's say this is a company, J&B's Farmhouse, right? And they issue contracts which says that you have, in this case, if there's only 4 contracts, then each contract would be like a 25% ownership in each one, right? Because it's a quarter. So you could be a stock owner of 25% of the company. But usually on the stock market, they have thousands of stocks, and you can buy 1 or 100 or 200. And you now own a piece of this asset. So maybe you own this little corner of the asset, you say? So that's stocks. Now, we don't normally buy or sell stocks, but what you do, people that buy stocks, let's say they bought it around here, and let's say they're a retiree, right? Retire. And he bought it at 200. Now, he doesn't want his value, let's say, to go less than 150. That'll destroy him. That'll destroy his retirement. So what he'll do, and I don't think people actually do this, but the people that know do this. He can pay the insurance man to insure, hey, would you promise to insure my stock at 150? He goes, yeah, sure, just give me some money and I'll do that. Which way are we going? This way. So if the stock goes down below, let's say it goes below 150, right? So the retiree now walks over to him and says, "Oi, can you give me that? Can you give me the value of my stock at 150, please?" Yeah, sure. And he pays him out, gives him the value of the stock. You see, and so he's protected and he's collected premium, but now he's had to pay out. And if you had to pay out all the time, yeah, you wouldn't make money. But there's many aspects to this. Let's say the price is around here. Now, what are the chances of the stock price going down here? Very little. What are the chances of the stock price going up there? Very little. What are the chances of the stock price going around here and here? Very much so. Good. So, one trick is to sell insurance around here and here. And yes, you can sell insurance on the upside as well as the downside. I won't go into that, but just know that you can sell insurance on both ends. So if you sold insurance around there, what would happen? You would probably just keep collecting dollars and you'd never have to pay out. Yeah, Blade, but what if the stock market does drop and then you have to pay out? Okay, let's continue. So, well, before we go there, actually, let me talk about that. What you could do, what if it goes down there? What you could do, let's say you buy and sold insurance here. And just as an example, let's say you collected $100 for selling these insurances, right? You collected $100. So what you could do is you could then protect yourself. You could perhaps back yourself up, and you could get insurance around here, just next to that insurance. So you go and buy insurance there, which now that's less. What usually happens is that insurance there will work out to be a bit less than those 2 insurances. And you say, well, how could that be? That should be more because it's closer to the probability, right? Well, there's a way to do it. So you actually um, come out on top with a credit. So you get a credit of $20, and then if you have to pay this insurance out, there might only be a difference of let's say maybe $100 between these that you have to pay out. So if you had to pay them out here, maybe it would have been like let's see, if you had to pay them out there, maybe you have to pay them out $1,000, right? But you got insurance here, which you're covered for 900. So you pay them 1,000, you're covered for nine. You're only short $100. You see. So if the market's usually around here, you just keep selling these like this, 20. So you'd have to sell five of these to make up that one loss. You sell those, manage your risk. There are actually ways where when it starts to get closer here, there are actually ways to avoid this bottom scenario altogether. So you can perhaps change it around and lose your 20 and just go to a zero amount of credit, right? But you haven't lost either. So there's ways to manage it as well. But then you get to keep all these 20 lots, $20, $20, 20, 20, 20, 20. If it gets into trouble, okay, maybe I have to pay 20 to get out. You can always go back to the guy that you got insurance money from. Hey, you gave me insurance money of $100, but you know what? The market's got risky now, and I tell you what, I don't want to insure you anymore, so I'm going to give you back. I've insured you paid $100 for 12 months. Market's risky. I'm going to give you back 50, and I'll keep the 50 for the first 6 months that I insured you, but the next 6 months. You can have your money back. I don't want to insure you anymore. So if you see something risky as an insurer as well, you can say, well, I don't want to insure you anymore. And yes, you can do that. So essentially what's happening, you're, now to cover the next thing, which is in the stock market, insurance is called options because you're giving someone an option to sell or an option to buy. I'm selling someone an option here to sell. I'm selling someone an option here to buy. So anything on this side, now this is quick, but just know that anything on this side is a call because usually that's the good side, and a call means you want to pick it up, like picking up the phone to make a call, right? And this side's called the put side. Usually that's the bad side, and that's a put. You do want to put it down. So you can sell options on puts and calls, basically. There's only four things you can do. You can either sell an option or sell insurance to sell, which would be a put. The sell here should be a put, right? Because it's going low. Maybe my wording's not right here, but anyway, just know that if this was if sell was put, maybe that should be put, and this is a call. This is a call. So you can sell insurance for puts, or you can buy insurance for puts to protect. So this is you selling to someone else. This is you buying it to protect yourself. This is you selling the calls to someone else. This is you protecting yourself. Now, what happens is you see this one you sold is bigger than this one you bought. This one you sold is bigger than this one you bought. The balance is your profit. You see? So that's how you make cash from cash, and you don't need 500k to get out of the rat race to do that, right? This will get better with your education. So your rate of return can maybe start at 10%, but there's typically no limit, right? You hear all sorts of stories, but it comes down to your education. Of course, when you first start off, you might not get anywhere, but if you're well educated, you can play it so you get a regular return and you can get out of the rat race. That's the goal, right? Here's an example of some of my weekly earnings. This is one 1, 2, 3, 4, 5, 6, 7, 8 week period. So, the first week I got this much above let's say my capital was 50 grand. I earned this much on the 50, and the second week I went that much, that much, right? First, second, third, fourth. Next week I've got this much up on my 50 grand. This one was a bit down because I think what happened is I either sold too much or bought too much. Actually, I was getting used to the platform. I think I clicked the wrong button and I thought I was buying and I was selling. Something happened. But anyway, you can see even with silly errors, it doesn't take too long to recover. So I'm now up that much on my capital. You see? What else have we got? That's it. So that's how you can get out of the rat race selling insurance on the market. Where's that 500? Oh, here it is. Yeah. And not necessarily needing 500 grand. I mean, you can start with 2K. I mean, you probably won't get out of the rat race on 2K, but if you learn this with 2K, 2K will soon be 3K, will soon be 5K, and then if you're saving and you're adding some dollars as well that'll be 6K and 10K. Before you know it, you're up at 20, 20K, 40K. The more your capital goes up, and the better you get at doing this, the closer you come to having your passive income, which is this trading. And yeah, it is passive because once you learn this, literally, it might take you 30 minutes to do your insurance trades for the day. I mean, seriously, is that really working? No, it's pretty passive, isn't it? And once you learn a few techniques, you can stop there and just do those all the time and never increase your education. But I highly recommend you keep learning though. So your passive needs to be greater than your expense. So, for average Joe, I don't know, but let's say it might be 5 grand per month. I think America or Australia, 5 grand's a good number. 5,000 per month might be your goal. So let's say if you got 50 grand, if you can generate a 10% return for the month doing those buying and selling insurances, that's it. You're done, you see. So that's how you do it. I hope that answers your question, Miguel. Leave some comments if you like, and I'll try and answer them as I go. So I'm going to try and progress these videos bit by bit at little gradient levels because I had it took me 2 years to get to where I am, where I understand some of it. I understand just a little bit of it. Well, I understand enough that I could do something with it, but I still got to have a lot to learn. And it was so hard. So I know if the more people you have explaining in different ways, the quicker and easier you'll come to learn and know it. So I hope I've done my job in being simple and explaining it. And I hope I've put some hope in you. If you're in the rat race, I definitely recommend go for it, learn it, find out about it, and get out. Thanks for watching.